Welcome to the Deep Dive. Today we're digging into a whole bunch of recent
Oh,
sources,
yeah, we've got market analyses, news articles, even an interview.
and it all revolves around, well, energy markets, global trade, and those tariffs everyone's talking about.
So our goal here really is to sort of cut through all that noise.
And pull out the key insights for you, the listener,
Yeah.
like what's really happening with energy prices.
And how are these tariffs actually changing things for industries, for international relations?
And, what does it actually mean for businesses and for people day to day?
Right. We think we've found some maybe surprising connections too.
Okay, let's jump in natural gas first.
Sounds good. So looking at the futures market, prices dipped a bit early this week.
Okay.
The July NYMEX contract, it was down about 5.3 cents, trading around 3.731 cents per MMB2. That was Monday morning.
Right, MMB2, the standard unit. And the technical charts, what were they showing? Any clues there?
Yeah, interesting stuff there. Natural gas, the nat gas USD pair, it's trading inside this ascending channel near 3.54042 cents, and it's basically testing a resistance level right there.
So resistance means it's struggling to go higher, like a ceiling.
Sort of. It suggests, a bit of indecision. Buyers and sellers are kind of facing off right now. The price is consolidating, holding above some key moving average support levels. But if it does pull back,
Yeah.
analysts are watching these Fibonacci levels, 3.427 cents, 3.377 cents, 3.326 cents. Those could be potential support zones.
And the indicators,
Yeah.
like RSI.
Both the stochastic and RSI are reading pretty neutral, so yeah, confirms that indecision. Neither buyers nor sellers really have the upper hand at the moment.
Okay, so the charts show a pause. What about the real world stuff driving the price? The fundamentals.
Well, the sources point to a couple of things. One, higher production numbers came out over the weekend.
More supply.
Right. And two, demand for LNG feed gas, that's the gas going to export terminals, it's been a bit sluggish.
Even with hotter weather forecasts, usually that pushes prices up.
Exactly. That higher supply and weaker LNG demand are kind of counteracting the heat effect right now.
Why is LNG demand sluggish? Is something specific going on?
Yeah, that's a key point. There's maintenance happening. Annual stuff at Sabine Pass, that's expected to run into late June.
Okay.
And the maintenance at Cameron LNG, which started back in May, it's actually gone on longer than usual.
So physical downtime at major plants.
Exactly. That's weighing down the total U.S. LNG feed gas volumes. It was about 13.5 billion cubic feet per day on Monday.
BCFD. Got it. So maintenance is a big factor.
It is. Although, for balance, the sources do mention that deliveries to Plaquemines and Freeport LNG are actually at record highs, so that's helping offset some of the weakness.
Okay, so a mixed picture on the LNG front. And I guess inventory numbers are always key here.
Absolutely crucial. Traders watch that storage data like hawks. Changes there, along with seasonal demand, can really move the market.
We also saw a quick note, Comstock Resources announced their Q2 2025 earnings date. Just, a reminder of the companies operating behind these prices.
Right. Exploration and production companies feeling these same pressures.
So for you listening, understanding this mix, the technical charts, the maintenance schedules, the production levels, it helps make sense of why gas prices are doing what they're doing.
It's never just one single thing, is it? Always a combination.
Definitely. Okay, let's shift gears to crude oil. WTI, West Texas Intermediate. It seems to have bounced back pretty well.
It has, yeah. A solid recovery from the recent lows, trading up near $64.54 a barrel, and it's also kind of bumping up against a resistance level.
Okay. And technically speaking.
The charts look pretty constructive, actually. WTI has been respecting an ascending trend line.
Meaning the trend is generally up.
Yeah, suggests the path of least resistance is still upwards, but like we said, it's paused near resistance, which is normal after a climb.
Are there levels to watch if it dips? Like those Fibonacci levels for gas?
Yep, same idea. Fib levels are highlighting potential support zones around $64.07, $63.69, and $63.58.
But there's always a but.
Well, yeah. The oscillators, like with gas, they're getting near overbought territory. So it suggests maybe a short-term pullback or correction could happen, even if the bigger trend is up.
And Brent crude, the international benchmark.
Brent's also heading towards resistance. It had that sideways period in May, which the analysis sees as corrective.
So consolidating before potentially moving higher.
Potentially. There's been a technical break suggesting more upside is possible. One target mentioned is around $73.
Wow. Right.
Although, the analysis also suggests using a fairly tight stop loss, maybe around $64.12 if you were trading that move.
Right.
Risk management.
Right. So both oil benchmarks looking technically positive, but maybe needing a breather. How does the whole global trade situation feed into this?
This is where it gets really interesting. The sources explicitly linked optimism about global trade talks, specifically the U.S.-China meeting in London right now to support for risk assets.
And oil is considered a risk asset.
Definitely. Because it's so tied to global economic growth. So the thinking is, if trade talks go well, it eases economic uncertainty, maybe boosts growth.
Which means more demand for oil.
Exactly. The sources draw that direct line. Better trade sentiment can literally lift oil prices.
We also saw some hard data points. China's May crude imports.
Yeah, 46.6 million metric tons. For the year so far, their imports are up just slightly, like 0.3% compared to last year. Still a huge number, obviously.
A key indicator. And on the supply side, OPEC Plus.
Right. OPEC Plus is apparently planning to increase supply faster in August and September. That could put some downward pressure on prices later in the year.
So potentially more supply coming.
And domestically here in the U.S., the oil and gas rig count actually dropped again for the 6th week in a row.
Fewer rigs drilling could mean less future production.
Could be a signal, yeah. So you've got energy prices caught between, their own supply and demand, maintenance issues, chart signals.
And the whole global mood around trade talks.
Precisely. It's this constant interplay. And that leads us right into the next big theme that runs through pretty much all these sources. Tariffs and trade uncertainties.
Yeah, this idea of tariff uncertainty really stood out, making present problems feel worse and future gains feel less certain. Let's unpack the broader impacts.
Okay, so fundamentally, tariffs are taxes on imported goods. The sources highlight the obvious impact. They raise costs for businesses.
Because the stuff they import costs more.
Right, and it messes up supply chains that were maybe built years ago based on totally different costs.
And there's actual economic analysis quantifying this.
There is. The CBO, that's the Nonpartisan Congressional Budget Office, they looked at it. They estimate tariffs could cut the federal deficit by, a lot. $2.8 trillion over 10 years.
That sounds good, but...
But they also figure it would shrink the overall U.S. economy, and it would push up inflation.
How much inflation?
Their estimate is about 0.4 percentage points on average for 2025 and 2026, which, directly hits people's purchasing power.
So, less deficit, maybe, but a smaller economy and higher prices. That's the trade-off they see.
That's their assessment, yeah, based on the tariffs in place mid-May.
Right.
And we see hints of this in other data, too, like the ISM Services PMI.
The survey of the services sector.
Right. It actually dipped into contraction in May. First time in a year. New orders fell sharply, and the prices businesses are paying for inputs, that jumped quite a bit.
And they mentioned tariffs.
The survey chair explicitly cited tariff impacts as contributing to those higher prices, so it's not just theory.
And this isn't just a U.S. thing, right?
No, not at all. The Bank of Canada, for example, they said their economy is softer and called tariffs the biggest headwind they face. That influenced their decision to hold interest rates.
Wow. And the impact on specific companies and consumers.
Oh, absolutely. It's very direct. We saw Procter & Gamble cutting 7,000 jobs. That's 6% of their workforce. Yeah, they explicitly mentioned falling consumer demand and higher costs because of tariffs, plus the unpredictable environment. One source cited a Reuters poll estimating the trade war cost companies over $34 billion already.
$34 billion.
Yeah.
In lost sales and higher costs.
That's the number cited.
Yeah.
Yeah. And there are other examples. Dollar Tree expecting weak profits, blaming tariff uncertainty. The UN Trade Agency warning tariffs will hike up seafood prices in the U.S. Car makers apparently using stealth price hikes.
Stealth price hikes, what's that?
Basically, finding less obvious ways to increase the price consumers pay to cover their own rise in costs from tariffs.
Sneaky.
And there was even an anecdote about wealthier Americans apparently shopping more at dollar stores, attributed to tariff-stoked consumer angst. Shows how wide the ripples are spreading.
It really does. The details on specific industries like electrical and construction were eye-opening, too.
They really were. That Wood Mackenzie study, it found tariffs could boost costs for power sector projects by 6 to 11%, mostly stuff coming from China. But here's the kicker. Utility-scale battery storage projects, costs could jump by as much as 50%.
Whoa, 50%. Why so high for batteries?
Because the U.S. relies so heavily on China for the actual battery cells. The sources say U.S. domestic production might only meet like 6% of demand next year, maybe 40% by 2030.
That's a huge gap, so tariffs on imports hit really hard there.
Massively. And the study also suggested utility-scale solar could end up costing way more in the U.S., like 54% more than Europe, 85% more than China in one scenario.
That's staggering. It has huge implications for, building out renewables affordably. How are companies actually responding to all this?
Well, they're adapting, definitely trying to diversify supply chains. That Richmond Fed study found around 30% of firms in construction and utilities are planning to shift, and 25% have already found domestic suppliers.
So a real effort to change where they get things from.
Yeah, but it's causing disruption too. Dodge Construction Network is warning about potential project delays or even cancellations because of the pricing and supply chain chaos.
Makes sense.
Interestingly, though, it's not universal panic. A Bank of England survey said UK firms are kind of shrugging off U.S. tariffs. And an AmCham survey found most U.S. firms in China are staying put for now.
So mixed reactions. Are companies trying to absorb the costs?
Some are trying creative solutions, like Fevertree and Molson Coors reportedly splitting the tariff costs with their suppliers instead of just passing it all to consumers.
Interesting strategy. And all this is happening while these big trade talks are going on.
Exactly, high-stakes negotiations. The U.S. and China are talking in London right now, trying to ease tensions, especially around rare earths and tech.
How's that going?
U.S. officials called day one good and fruitful. The Chinese delegation was quiet publicly. President Trump said China's not easy, but he'd heard good reports. So, careful optimism maybe.
And it seems like both sides are using key materials as bargaining chips.
Oh, absolutely. The U.S. is apparently restricting exports of ethane vital for China's plastics industry. One source called it a geopolitical weapon. And China, of course, has curbed exports of rare earths before. Those are crucial for EVs tech. One report said auto companies are in full panic over potential rare earth shortages.
Even though China's exports actually went up recently.
Yeah, exports jumped 23% in May, but the strategic threat, the potential for restriction, that's what seems to be causing the anxiety. It's about control.
And there are other talks happening too, right? Not just U.S.-China.
Right. U.S.-India talks got extended, aiming for an interim deal by early July, focused on farming and auto tariffs.
Okay.
The U.S. only has one new trade deal done recently with the U.K. The EU is apparently willing to talk about lowering tariffs on U.S. fertilizers. Japan wants to cooperate on rare earths with the U.S.
And Canada, with the steel and aluminum tariffs.
Yeah, Canada's figuring out how to respond to the U.S. doubling those tariffs to 50%. Their PM called it unlawful and unjustified. Meanwhile, the UK Prime Minister seems confident the tariffs on British steel will go back to zero soon.
So a lot of moving parts.
Yeah.
And those doubled U.S. steel and aluminum tariffs are actually in effect now.
Yes, since June 4th. Raised to 50%. The idea seems to be to pressure countries into making best offers to avoid them.
And can we see the impact in trade data yet?
Oh, yeah. U.S. container imports from China plunged, down 28.5% year-on-year in May. That's linked to those huge 145% tariffs already on some goods.
And overall imports.
Overall, U.S. seaborne imports dipped too. And flip side, China's exports to the U.S. fell the most since 2020, even while their total global exports actually went up.
So the tariffs are definitely redirecting trade flows.
Uh-huh.
And it's not just about goods, is it? It spills over.
Right. The sources mention things like delays to Apple rolling out its new AI features in China. It shows how these trade tensions affect tech, services, everything.
Okay, so that's the big picture on trade and tariffs. Let's bring it back down to earth a bit. We looked at an interview with Tom Ayers from Kent Plisk, an energy engineering firm.
Yeah, Kent's a pretty big deal in that world. About 14,000 employees, 26 countries. They grew by acquiring other firms like S&C Lavalins Oil and Gas Division, Atkins Oil and Gas, Houston Offshore Engineering.
So they do the engineering for big energy projects.
End-to-end solutions, yeah. Ayers talk a lot about their offshore work floating systems for oil and gas, wind power, designing the huge hulls and the topside structures.
And some specific examples?
He mentioned the Woodside Scarborough project in Australia. Really complex stuff, detailed engineering, helping manage operations like floating massive modules into place.
And are they developing new kinds of tech as well?
Definitely. They've designed things like a smaller, semi-submersible platform that can also store condensate, sort of like a mini FPSO.
FPSO, floating production storage and offloading.
Right. And another interesting one is a dedicated utility floater just for water injection.
Water injection.
Yeah, to maintain pressure in oil reservoirs. This floater filters seawater, removes sulfur, and pumps it down at incredibly high pressure, like 10,000 psi.
Wow.
Ayers made the point that because of this work, they're kind of in the water business too now, not just oil and gas or energy.
That's fascinating. How do they even start designing something like that?
He described their front-end process, basically starting with a blank sheet, filtering ideas, narrowing options, using experience, first he called it your noggin, then building complex financial models, CapEx, OpEx, to figure out feasibility.
Are they using newer tech like AI in that process?
They are. He mentioned using things like ChatGPT for initial cost estimates, and this is key, always validated by experienced engineers.
Human oversight.
Exactly. And they're also using AI to spot anomalies in massive data sets coming from sensors on equipment, like vibration sensors on big compressors.
Why is that so important?
Well, partly because experienced staff are retiring and you lose that intuition, but also modern equipment just generates so much data. AI is needed to sift through it effectively. It helps predict failures, extend equipment life.
That ties into that idea that humans plus AI often beats either one alone.
Right.
And sensors keeping things running longer.
Yeah, it shows how tech is being used not just for brand new designs, but to optimize what's already running.
So what was Ayers' general feeling about the state of the energy engineering industry now?
He was pretty candid, said projects used to be hell, but now they're starting to be fun again.
Fun, really?
Well, fun, maybe relatively speaking. He quickly added, they're still definitely not easy. His focus now is really boosting Kent's brand recognition.
So for you listening, hearing from someone like Ayers, it gives that ground-level view, doesn't it? It shows how companies in the energy sector are actually navigating all these complex market forces and trade policies we've been talking about.
Yeah, it puts a face on the trends, shows the innovation happening despite the challenges.
Okay, so let's try and pull this all together. Final thoughts from this deep dive. The connections are just, well, they're everywhere.
Absolutely. Energy prices are doing their own dance based on supply, demand, maintenance, drilling.
But that dance is constantly being influenced by the wider global mood, especially around trade talks and tariffs.
And those tariffs, they're not just lines in a policy document. We've seen they directly hit business costs, force supply chain changes.
Influence hiring, pricing, consumer spending.
And even become bargaining chips in global negotiations over really critical resources, rare earths, battery components.
Incredibly dynamic, constantly changing, makes staying informed pretty crucial.
It really does. Which leads us to maybe a final thought for you to chew on. Given how deeply these tariffs are biting and how strategic things like rare earths and ethane are becoming, how might global supply chains fundamentally change in the next few years, moving beyond just cost towards more strategic control of key materials? And what does that shift mean for international cooperation versus competition?